Just want to run through just a very quick preview with REITs. Obviously, there's a few that are kicked off today. SCP was out this morning. But looking at reporting season with REITs, very much focusing on the FY18 outlook with regard to distribution. There is some 18 guidance already in the market, but I think some of the other themes that will tend to come out over the next couple of weeks is there will be ongoing M&A. We've sort of highlighted this as a theme throughout 2017. I think it will continue to play out. Obviously, the live sort of deals at the moment are obviously the AJD Next DC 360 sort of triangle. The Cromwell IOF deal, which has gone very quiet, will be interesting to see if there's any update with that with the result in a couple of weeks. Buybacks potentially, we may see some more buybacks. Vicinity obviously announced it was introducing a buyback a couple of weeks ago and actually got a good re-rate off the back of that. So whether or not with some of these, particularly on the retail side, whether some of those REITs come in with some buybacks. As Joe's obviously been talking to a lot, the Amazon sentiment has weighed heavily on a lot of the retail REITs. I think everyone will be looking to see how these guys are trading. A lot of them are back at NTA. You've got Vicinity at NTA, SCP at NTA, Aventus at NTA. So it will be good to see some of the trading updates with those guys. I guess with a lot of these, some of the bigger houses have gone overweight the retail REITs in the last couple of weeks, upgrading them to buys. So we'll look through for some commentary there. Clearly, leasing will be a topic. Sydney and Melbourne don't seem to be slowing down, particularly Sydney, anytime soon. So expect that theme will continue. I don't think there'll be a huge change from February where you'll see sort of okay markets in sort of Brisbane, Perth. No real change. Canberra probably still mixed. So again, looking for that. Balance sheets all round are pretty sound. I think the average gearing is still around 30%. With some of the bigger guys, they're probably in the low 20s. So you've got GPT and others sort of at around that 24% level. Those with high gearing have flagged they are looking medium term to move it down. So I think you will continue to see some asset sales in the medium term. Might create some income holes short term, but the commentary for guys with probably above market, above peer gearing is that they will look to do some asset sales in those non-core, what they consider non-core. Look, with cap rates, obviously the pace has been quite steady over the last few years. Expect it will slow, but in February, probably the average growth, most groups posted sort of 4 to 8% NTA growth. Sydney office is obviously a key driver here, but I think we'll continue to see some NTA growth with results. And as Nathan highlighted yesterday, we're obviously still seeing low interest rates and low inflation. So on the yields, at the moment, probably for the ASX 200, average yield is just over 5%. Looking across the whole sector, it's probably just above 6%. Bond yields obviously currently around 2.6%. So there's a sort of 270 basis point margin there. Probably the average long-term margin is under 2%. So that's current pre-reporting. Again, discount to premium. As I mentioned, a lot of the retail guys are now trading back at in line with NTA. A few of the others there, like Dexus, obviously just completely, driven by that Sydney exposure, and a few others are obviously AJD, obviously with current movements. Looking across the sector, going forward, you're probably looking at average TSR of about 9 to 10% for most groups. And just finishing on some ideas, for yield, look, still very comfortable with Viva. They've got fixed 3% increases. The lease expiry, the WALE is very long, so you've got comfort around the income. It's currently yielding about 6%. It will actually report a half-yearly result. I don't expect much new news or revaluations with that result. Centuria Industrial, which we know well, very vanilla Australian industrial, currently yielding just about 8.2%. It's paid quarterly. Look, we'll be looking obviously for FY18 guidance and some of that leasing updates with regard to 18-19 expiries. And as I mentioned, trading back at NTA, a stock again we know well is Aventus, has been hit. Obviously did a big capital raising recently and with the retail sentiment, but trading around NTA, It reports on Thursday, so we don't have to wait long to sort of get a feel on where the leasing sits there. But a quality portfolio, so comfortable with Aventus. And look, if you're wanting some large cap exposure, still comfortable with the diversified groups. Obviously with Stockland, you're getting residential exposure, but the residential has held up very well.